Welcome to the scenario set piece. Throughout this series, we'll break down the numbers, the costs, and how lender policy all play a part in purchasing your property in Australia. I'm Vangelia Colliers, the Director and Mortgage Broker at VK Financial. We are your finance teammate in helping purchasing your first home or investment property. Now in today's episode, we'll show you how you can use equity from your first property to help purchase a second property. Alright, let's draw up the scenario. Firstly, we live in our property in New South Wales and want to purchase an investment property in Queensland. We assume that we can service the entire loans for this example, and we want to compare what it will be like to purchase a property using equity from our home in New South Wales or using our full savings. Alright, so let's look at set piece 1. So the first thing we do is get a valuation on your property. So usually we do this through an automated valuation with your current lender, or if we need to, we get a short form valuation, which is a walk-in val, to assess the value of your property. We can also run a number of valuations across different lenders to see what potential equity you have across the market. Now for this example, we've gone to our bank and they've valued our property at $600,000. We have $360,000 left on our loan. So now let's work out the equity available that we have. Now equity is the difference between the value of your property and what is left owing on your loan. Generally, lenders will threshold this equity at 80%. So for this example, our value of the property is $600,000. The remainder of our loan is $360K, and our equity, which is 80% of the value of the property, is $480,000. Now our loan balance, loan 1, is $360,000. The equity is $120,000, which is loan 2, giving our total loan to $480,000. The LVR, or loan to value ratio, is 80% of the property value. Now part 2 is the investment property purchased in Queensland. Now the equity can be used to cover the deposit and costs of this property purchase. Now an important consideration to note is that equity comes at a cost, whether it's interest through the bank or if you sell the property and cash in on that equity. Now let's go back to the table. So our property value for our purchase in Queensland is $500,000. Our investment loan, which is loan 3, is $400,000. $0 in lender's mortgage insurance because we have a 20% deposit, given our LVR of 80% and our total loan of $400,000. So the purchase costs are as follows. Our deposit is $100,000, so that's the loan minus the value of the property. Our Queensland stamp duty is $15,925. Our legal costs, our mortgage registration costs, and our adjustments are estimated at $3,650, given our total purchase cost for the property being $119,575. Now the funds available we have through the equity release is $120K, which gives us a surplus in savings of $425 after the loan settles. So with that equity, we can actually make this purchase work. So that is how you purchase a property using equity from your first property to purchase a second property. Now, what are some considerations we have to take into account? First of all, you have to show the bank that you can service the loans and make the repayments on all 3 loans. So let's look at the differences between the serviceability of the equity and using your full savings for the purchase. Now here on the left, you'll see that our owner-occupied loan is $360,000, our equity release, which is loan 2, $120,000, and our investment loan of $400,000 give us a total serviceability of $880,000. Now we have to show the bank that we can service this entire debt. Now if we were to use our full savings for the purchase, we'd only have 2 loans to show the bank for serviceability, being the owner-occupied loan, $360,000, no equity because we're using our full savings, and the third loan, which is the investment loan of $400,000, giving our total serviceability to show the bank of $760,000. The benefit with using equity to purchase your next property is that it can actually cover the costs, which are your deposit and your stamp duty costs, for your next investment property purchase. Now this is a great way to start leveraging your existing asset to actually help you buy more properties in the future. Now the time it took to eventually save this amount to make this purchase work could actually be accelerated through the equity and growth of your current property. The risk is that you have to show the bank that you can make the repayments and serviceability on 3 loans as opposed to 2. Our 3 loans are the owner-occupied loan, our equity release, and our investment loan. Whereas if we used our full savings, we'd only have the 2 loans being the owner-occupied loan and the investment loan. Over time, this is going to become more of a constraint, having to use your equity from each property to keep purchasing your next property. So there you have it. That's how you use equity from your first property to help purchase a second property. If you're looking to purchase your second property, give us a call. I'm Vangeli Colliers from VK Financial, your finance teammate.